Hello, thank you for joining us for this week's Market Carver. I'm joined by Zach, who's filling in for Adam this week. We have two key topics that we want to talk to you about. One is a historic chart, doing a little bit of comparison, talking a lot of things I've been talking about recently about the lack of large participation by individual stocks. And then Zach, afterward, will be giving us an update looking at the labor market after we got some new data at the end of June. So again, the first chart I wanted to share comes from a friend of mine named Jason at Sentiment Trader, and what he was looking at, and this is a topic we've been discussing a lot in our allocation meetings, I've been talking to you about it in the Market Carver, is how we're seeing a lot of stocks not participating on the uptrend. We're seeing the market continue to hit new highs, very encouraged by that. But when we look below the surface, we're not seeing a lot of stocks doing the same. And so I often look at the S&P 500, the 500 largest stocks in the US. Jason here is actually looking at a broader index, looking at the NASDAQ composite. Now, the NASDAQ composite has a lot more technology, has a little bit more higher volatile type stocks in it, but it still gives a good representation of the US stock market. What he was looking at here, and what this chart, as I'll unpack for you, shows is the NASDAQ going back to 1990, and then those blue lines show the number of days where the NASDAQ hit a new high, but actually more than 3% of the stocks were actually making a new low, which is very unusual. Typically, you'll have most stocks that are going higher, and you have very few, if any, stocks that are actually making a new low. So you can see that these lines don't happen very often. We saw a buildup of four days of this type of price action occur, or in the around 1999, and then at the actual ultimate peak at 2000. Then we also saw it again in 2007 in a period of time in 2015. Then again during, actually right before the COVID crash in 2020. And then we did have a couple days before the 2022 decline. Now we go all the way to the right side of the chart, looking at today's data. And we've actually had, as of this chart, which is as of Friday last week, actually have had 9 days. So more than double the prior record of the NASDAQ continuing to hit these new highs. But we're starting to see more and more stocks hitting new lows. In the allocation meeting, I did the same type of analysis looking at 6-month lows for large cap stocks. We're seeing about 5% of those are making new lows as well. So we are starting to see some breakdown of individual stocks. It's not just that they weren't going higher, it's actually many of them are starting to go lower as well. However, as we often talk about, the FANG stocks, the Mag 7, those big stocks, the mega caps, they continue to prop up the index itself, keeping the market looking fairly healthy because it keeps hitting new highs, marginally so, but it's continuing to provide the necessary support, and those stocks are so massive that it only takes a couple of them to rise to keep the overall market in that uptrend. What we're continuing to monitor every single day is looking for if we do start seeing the market respond to this bearish breadth data, and then we will take up the appropriate action. But the opposite could obviously occur. We could continue to see the market move higher, and this bearish type of market data corrects itself over time. That's why we're not trying to be too aggressive in front running what we're starting to see below the hood and start looking for signs of confirmation. All right, well, looking at the market, now we're going to go over to Zach, who's going to give us some insights into some of the economic data we've recently got.
Yeah, so what we're going to see here is a chart of the U.S. unemployment rate. And if you look down there in the bottom right-hand corner, you'll see that we have started to tick up a little bit. This data point, unemployment rate, along with a handful of other data points, point towards a cooling labor market. And that shouldn't be unexpected for two primary reasons. The first, a tick up in unemployment rate is a natural product of a Federal Reserve raising interest rates to combat inflation. The other is that we are coming off of a 50-year low in unemployment rate. And so it seems natural that it would start to drift higher over time. While these data points, a cooling labor market, can precede economic contraction, you'll see that they're highlighted by those light gray bars. The most important thing to note is that it does impact or can impact how the Federal Reserve proceeds in their coming meetings, both in July and then again in September. They've been fairly vocal about not wanting to involve themselves in the election. So as of right now, we're seeing that based on futures trader data, that they're not expected to see a rate cut in July at the end of this month, but the percentages are rising, about a 70% chance based on futures traders that we will see the first cut in September. Obviously, cooling labor market as well as some weakening economic data could spur the Fed to make that move in September and increase the odds that actually happens. It's important to note, we've said this many times before, but it's important to note again here that the market and the economy are different things. And so our job is to focus on the market. However, there is some commingling where what the Fed decides to do, particularly in regard to interest rates, can play out or have a ripple effect in the economy, particularly in fixed income. And so as we monitor economic data, more specifically labor market data, as we listen to the Fed and kind of gauge where they're going, our primary focus will be how that impacts the fixed income market and how we can position ourselves accordingly.
Thank you, Zach. So those are some of the topics that we discussed on Monday at our weekly allocation meeting. Hopefully you find them interesting as well. As always, thank you so much for joining us. If you do have any questions or you'd like to schedule a meeting, you can use the phone number, the URL, or the QR code there on your screens. We look forward to having one of our team members be able to talk with you. Until next week, have a great week, and we'll be back in your inbox next Thursday. Bye.